Welcome to today's webinar on construction sector conditions. I'm Haley Shenander of the Federal Reserve Bank of Minneapolis. Before I turn it over to our speaker today, I have a few housekeeping items. Slides for this presentation and a copy of the video link will be emailed to all registered attendees next week. Ron will be entertaining questions at the end of his presentation. If you have a question, please type it in the chat box on Zoom. We'd love to get your feedback at the end of this presentation as well, so please take a moment to fill out the brief 3-question survey that pops up in your Zoom window when you exit the webinar. And with that, I'll turn it over to Ron.
Thank you, Haley, and thank you everyone for attending today. I think there's some interesting things to talk about with the construction sector. I think everybody online here knows that there have been some challenges to the sector, and we had a lot of firms give us a lot of feedback that I'm happy to share with you today. And as Haley mentioned, we'll be sharing this information afterwards as well. Before I get started today, I need to give you my disclaimer. So the views that I express here are mine and not those of the Federal Reserve Bank of Minneapolis or the Federal Reserve System. So first, before we get started, and for those that have been regular attendees to the webinar, first, thanks. Just going to go over some kind of general things that I go through before all of these. And the first thing is just a thank you to the partners. This is the largest construction-focused survey among the 12 Federal Reserve District banks, so we're very proud of that. And that can only happen through our partners and through the members that are responding to this survey. So a really big thank you. This wouldn't happen without you, and it really is important because the way we distribute this is the construction trade organizations that are our partners. They actually get our survey out to their members, and that's important because there's really kind of 3 parts to this. It provides us, the Minneapolis Fed, our partners, with necessary information on how things are going, and they share that with their partners, and we also share it with the public. So I think this is just a really good way of helping everybody better understand the sector. We also have one new partner that I just want to give a quick shout out to, the Montana Building Industry Association. So we thank them for their partnership. If there's anyone listening that is part of an industry trade group that wants to be involved, there's some information at the very end. I'd love to hear from you because we're always looking for new partners. So just a little bit of survey background, just to give you an idea of who's responding. First, we conducted this survey in mid-April, April 15th to the 29th. We got 285 responses, which is a little bit less than the November survey, but more than last April's survey. We had pretty good balance by sector and firm size, and I have some charts here to kind of demonstrate that. In terms of by sector and firm size, the one on the bottom, we see pretty good balance, a little bit more non-residential and commercial, but not a dramatic number. Respondents by firm size has actually been really quite consistent over time. There's a little bit of fluctuation, but we're really comfortable with this, especially because we're getting more large firms in terms of the sample size, and we think that's a really good indicator of overall activity. We do, in terms of geography, have a little bit of overweight in terms of respondents from St. Paul and Minneapolis. We're also underweighted in terms of respondents from Wisconsin, but in terms of the overall balance, the fact that the sectors and the firm size are pretty similar, we really like our overall representation. I do want to remind everyone, though, that these results are a snapshot. This is not a scientifically sampled survey, so we think this is a better directional survey and not necessarily a pinpoint accuracy kind of survey. So please interpret everything that I have to say here in these charts real carefully. So with that, let me just kind of get started on a broad overview. So some takeaways that I take away from this. As a single snapshot, this survey doesn't necessarily suggest things are great. It's when you compare this survey to the previous surveys that to me, there are some signs of modest improvement. So revenue and profit trends are still net negative, but they are less so than previous surveys. Infrastructure seems to be doing the best. That's been the case actually for a number of surveys now. Residential and commercial are still clearly challenged, but the respondents are suggesting that there is some improvement. Industrial saw the biggest dip in overall sentiment. Some other concerning things I would say is new and future projects are still in decline, and we're seeing backlogs also shrink. But labor demand is still really solid, and I think that's a really nice indicator. Labor availability for employers is also improving fairly dramatically. The outlook overall is upbeat. That's not unusual in springtime. I think that's when things generally tend to get busier and overall. but I would say there are also a few other signs that I'll point out towards the end of this webinar that kind of give me a little bit of a glimmer of hope that things are improving. So let's take it back a little bit and just start from the beginning in terms of recent revenue and profit trends. So again, let me, for those that have heard this before, just bear with me. In terms of a lot of the charts that you'll see this kind of design. Generally, red means bad or decline, green means good or growth. The first question that we ask is about recent revenue trends and future expectations. And what you take away here is that recent revenue is still slightly net negative. We're seeing just very slightly more reporting that revenue is declining versus increasing. But if you look to the bottom bar in terms of what they're expecting in the future, that has turned positive, and that's a good sign. And it's also compared to previous surveys that we're seeing that. So here is that chart. And what I will also tell you up front here is that typically I will include November survey results, but I'm very typically going to talk more about the comparison to the April 2023 trend, in part because everyone knows that construction is seasonal. So I think the April to April comparison is a little bit better comparison in terms of seeing where the industry is at right now. So we are seeing notable improvement over November, but even over that year over year, we're seeing slight improvement on that as well. Oops, wrong way. Sorry about that. So in terms of future revenue as well, here I would say there's a little bit less optimism. I think there's always optimism for the future. And here in terms of what they're expecting in the coming months, we're seeing actually a notable improvement over 2023. What I would say is it's actually in the neighborhood of where April 2022 is when interest rates first started going up. In terms of company profits, I would say the news here is also getting much better. So recent profit levels still remain negative. So I want to be clear that that's obviously not a good trend. So we're seeing more firms say that their profits are shrinking versus increasing. But if you look at, and that would be the top chart there. So, there has been steady improvement in terms of the number that are reporting declines. That's good news. And then in terms of profit expectation, here we're actually seeing a real notable jump, not only over the November survey, but also over the April 2023 survey. So again, current conditions, not necessarily great, but they do appear to be improving compared to previous surveys. So some sector breakdown. So we ask firms a number of kind of identifiers to help us kind of splice and dice some of the data. I'll give you a little bit of that right now. I think the most important one is the sector. I'll talk more than a little bit about the breakdown as it relates to infrastructure, non-residential, residential, and industrial. And in terms of overall sectoral performance, I won't break all of the questions down along these lines. In general, the revenue trend is also what I see in most of the other questions and other metrics. And infrastructure leads. Residential and commercial actually saw the biggest improvement, even though some of the data here that you're seeing doesn't necessarily suggest a lot of positivity. Still more reporting for residential, for example, are reporting revenue declines. But in previous surveys, it was even more negative. So we're seeing some improvement among residential and non-residential or commercial. And industrial is actually the one that saw the biggest decline, the most, where we saw a little bit of drop in those seeing increases and a notable increase in those that were seeing revenue declines, both in terms of the recent revenue and the revenue expectations going forward. The outlook, it really has improved for all four except industrial. I also like to just kind of try to triangulate what respondents are telling us with what data we can find on certain sectors. Now, these don't line up exactly. I get this data source from Dodge Data and Analytics, so they use a little bit different categories. So this isn't exactly like the framework I use, but it's pretty similar. And what you see in terms of the total value of construction starts for the first quarter, so January through March, for first quarter 2024 versus first quarter 2023 is that we are actually seeing improvement in terms of that metric and across all three categories: non-building, residential, non-residential. So what we're hearing that things are improving comparatively still seems to resonate here with private data as well. I also pay very close attention to housing permit data. I'll walk you through this very clearly. On the left, single family permits declined for 2 years in a row through 2023. That's the very left-hand chart. The next chart over is the first quarter for 2024. Okay, and we're seeing that that actually saw a fairly nice increase in the first quarter so far in 2024 compared to last year. Multifamily permits, not exactly the same story. So we didn't really see a big decline until last year, 2023. First quarter so far this year, the very far right chart actually is still showing that there is some decline compared to the first quarter of last year. So a few other things that we like to find out about from our respondents, and that's project backlogs. We want to know how much book of business they have kind of waiting to happen. That's a very good sign of healthy demand, and we are still seeing that it's overall net negative. It improved, but it improved marginally over time. So if you look at the chart on the right, if you look at it April 2024 compared to last year, we are seeing some small improvement in that over time, and particularly compared to November. And then if you look at the smaller chart in the bottom left, in terms of who's seen backlog improvements or not so much, kind of what I had mentioned before, infrastructure doing better than all of the other three. Residential actually has seen some improvement on this as well, but modest. Then we also look for requests for proposals, or those new projects that are out for bid. And we like to ask because both private and public projects are kind of distinct markets, and some firms are heavily in one or the other. So we like to kind of split that out. And what I would say is that, again, compared to last year, April 2023, for our new projects out for bid, we're seeing what I could only say modest improvement from a very poor situation a year ago. In terms of public projects, this actually hasn't changed that much. Here also, not surprisingly, infrastructure firms were the only ones seeing net growth in this sector. So clearly, there's still many, many, many challenges that respondents are seeing in terms of just doing business. So this is over the last 3 surveys going back to April 2023. And here what you see is that higher interest rates seem to be less of a concern. I don't want to say, because interest rates haven't changed that much since November, I don't want to say this is a book it kind of trend. But for this period, at least, we are seeing that there's a little less concern regarding higher interest rates, though it's clearly still a concern. The other thing is that the material costs and labor availability, the two on the very right-hand side, seem to still be very persistent. I don't think that's a real surprise. Labor availability is likely to be a challenge for the ongoing future. In terms of material input costs, we see some pricing on that area, and I'll offer a little bit more information on this later in this presentation. We're seeing that decline, but we didn't see much of a change, especially from November. And then lastly, the one thing we have seen, supply chain was such an issue a year or two ago. We are seeing a very steady decline in that being an issue. I would also point you to the wage pressure to the farther left, and that it's not an inconsequential share of people that are saying, roughly about 1 in 5 are saying that's a challenge for them, and that's something we're paying attention to as well. In terms of the general trajectory, we kind of want to get a sense for what's getting better and what's getting worse. I think the chart here says most people think most things aren't getting better. I'll offer a little bit of information on a couple of these, but in general, many challenges don't really appear to have necessarily peaked in terms of getting better or worse, at least according to respondents. Again, save for that supply chain disruption. But there are a few things. I'm going to offer a little bit of evidence that maybe some of these things are getting a little bit better than they might reflect here. One of those things is prices. So we are seeing inflation clearly is still a problem, but we are seeing that respondents are reporting that their own prices, both the prices that they are paying to vendors, so that's the chart on the left, the wholesale pricing, we are seeing that inflation come down pretty significantly. We're seeing it decline even more, or we're seeing it slow. That's a better way to put it. We are seeing inflation slow more at the retail level, even more. So I think both suggest that inflation isn't good. I wouldn't ever try to convince anybody of that, but it is. But the growth rates are slowing, and that's a good sign. In terms of labor demand, I think the positive thing here, even given all of the challenges, as well as an activity level that is still not as quick or as fast as people would like, that firms are still hiring. The only reason I have only November on this chart is we actually changed the wording of this question so they weren't comparable over time. So I only have November results to compare to. So we shouldn't be surprised first that more are hiring new and full-time, the bars on the very left, because there's seasonal hiring that is clearly happening as firms get busy and get into the busy season. So we should have expected hiring to be higher than November, but overall, 3 of 4 firms are hiring in some capacity, and we're only seeing about 25%. Actually, it'd be a little bit more than that, about 30%, 35% that are not hiring at all. I should change that a little bit. So maybe a little bit less than 3 and 4, probably closer to 65, 70% are hiring. Still a very strong number, especially for an industry that is otherwise feeling like it's maybe back on its heels a little bit. The really good news here for employers is that they are having a lot more ease in finding workers when they are hiring. This is probably the biggest change of any that I saw in this particular survey. That they are still having difficulty when roughly 70% are still having either moderate or significant difficulty in finding labor. That's notable. I wouldn't call this an easy labor market, but those share that are seeing it be very difficult has actually declined, and I think that's notable. I also like to kind of triangulate this one with some of the data that is available. On the chart on the left is construction employment across the 9th District states, and here you can see that it is still increasing, and that's not terribly surprising leading into the busy season, but these are seasonally adjusted, so we are continuing to see employment rise. In terms of the individual states, it's a little bit better idea on the chart on the right on how each state is performing. This is an index chart. So basically this is the rate of change over time. And what you see here is that North Dakota has seen the worst trend of all of the district states. That's mostly due to the energy sector. And going into the pandemic and what happened in the energy industry. And they are still, I would say, kind of being more cautious about any expansion there. And Minnesota also, I think that would be the orange line here, has seen more steady or plateaued kind of employment trend. Went down over the last year just a little bit, but has ticked up. I would expect that line to continue rising if firms are having a busy summer season. Wages are another thing that we're seeing some moderation in. So here I posted for the last 2 surveys just to give you a little bit of idea where I want to put your eyes. And that is in the November one, we had been starting to see wages moderate a little bit. They're not weak by a long shot. They're still quite strong, but they are less strong than they were in previous surveys. In particular, in November, respondents expected wage increases over the coming year to start moderating even more. That's not uncommon for firms to say in general. I think there's always where wages are strong, they expect that can't continue. This is the one survey, if you go then down to the April survey for the same bars, is that the increase actually met what they expected it to, and they expect it to hold there. So we are seeing that wages overall are falling modestly, and that's the chart also on the right. The one over time also suggests that wages for skilled trades are coming down slowly. So finally, just some outlook, and here I'll offer just a little bit more information than I have in previous webinars in terms of some outlook. So in terms of what firms are predicting for the next 6 months, here it really interesting in that we see almost no change over the last 3 April surveys. So I think part of that is for April, we're going into the busy season. Things are getting busy, that busier than they were. That always feels good. And I think there's some optimism that is leveraged because of that. So this is kind of a good news, bad news. It's still quite positive, actually. It's been quite positive the last 2 Aprils as well. So I think it's kind of steady as she goes in terms of that outlook. In terms of the outlook for the next 6 months by sector, here also is actually quite positive. Residential, you have a positive outlook, non-residential and infrastructure quite so. The one I would point you to is industrial, and here I think was where I saw the biggest change in overall sentiment compared to other years. So there is something happening here that I think is worth tracking a little bit more. So one other thing that I'm just going to bring to people's attention, and I want to kind of offer a few caveats as I go through this. So normally we ask respondents to identify what firm type they are within the construction continuum. So it could be architects, engineers, a lot of different kinds of contractors, supply materials, etc. And what I wanted to point here, I was kind of curious at how maybe different firms within kind of the typical time frame of a project, how they were responding differently. And first, I want to note that the number of architects and design that respond to this is generally pretty small. We're talking typically 20 or 25 firms, which is small. So I want to make sure I emphasize that. So we can't necessarily say this is a great snapshot, but I thought it was worth noting that in spring of 2023, the top chart, if you look at it, architects and design were really signaling that things were slowing for them. And if you look at the most recent survey, it's the exact opposite, that architects and designers are suggesting that things are improving. Now, maybe that's from very low levels, so I think we have to take that with a grain of salt. We don't really know like the degree of growth that means. But again, in terms of trying to look at maybe where the sector is headed, I thought this was kind of a useful result to share with a grain of salt. In terms of requests for proposals, kind of the same thing. So the same caveats apply here, but also to me, a reasonably good signal that architecture and design was seeing the strongest share of those that were seeing significantly lower projects out for bid a year ago. And this year, they are seeing more growth in that area. And so I thought that was something kind of just worth noting. So real quick wrap up here, just kind of summarize. Again, on a snapshot basis, things still don't look great. We know there are a lot of challenges, and this is not I would not say the things that we found out from the survey suggest that we've, really absolutely turned a corner and things are going to be great. But I would also say that results over time suggest that there are some improvements in the industry and that things don't appear to be getting worse. Revenue and profits are still net negative. That's the snapshot, but over time it's been less so. Infrastructure is doing the best. I think federal spending on infrastructure, I think, is clearly having an impact here. Residential and commercial are seeing some modest improvements, but I think there's still lots of challenges in those sectors. And industrial saw the biggest pullback here, and I can't. That's one of the areas that I can't say I know an awful lot about. That's something that I'm going to follow more going forward. Future activity also giving some mixed signals. New projects out for bid or requests for proposals and project backlogs are still shrinking, but we're seeing, again, some improvement over time on those. I think more importantly, though, firms are still hiring. And in terms of any signal, firms that are still looking for more labor suggest to me that there's some optimism in their outlook. Inflation and wage pressure is still very present, but both of those are heading in a direction that I think are good. And then the outlook is still optimistic overall. That hasn't changed much. I think firms, it's probably just a point of necessity to be optimistic about your business going forward. But there are some other signs that I think offer some modest hope. So that's the end of my formal remarks. I'll leave this screen up very briefly. Haley, if I don't know if any attendees have put any questions in the chat box, but I'd be happy to take those right now.
Yeah, great. We have had some questions come in, and just as a reminder for everyone, if you do have questions, please type them in the chat box on Zoom. So let's start with this one. Someone was wondering, you mentioned that residential activity has improved from low levels seen in the previous survey or two. What's behind the improved sentiment given mortgage rates are still comparatively high?
Right. Great question. And let me just reiterate, these are my opinions, not those of the Minneapolis Fed. I think if I had to guess, and from what I hear kind of on the ground, I think some of it probably has to do with there being an awful lot of pent-up demand. And I think some of it might have been waiting on the sidelines, hoping that rates were going down at least soon or by this time. And I think the market is signaling that maybe rates are going to stay higher for longer. And I think that maybe has motivated people to get off the sideline and to actually get projects moving in terms of them, deciding to build a house. So I think there's something going on with that. I also would kind of point out that while current development has increased, it's still not great. It declined pretty significantly for 2 years. So the fact that we saw a first quarter bump, great news. But I would not say that it is too strong of a signal yet, because quarter one will see the least number of homes built. It's quarter two and quarter three where we really will see what the actual trend is on that.
For sure. Someone else was wondering, on your labor availability question, did you happen to hear anything if they've changed their parameters for hiring? Are those qualified candidates that they're hiring, or are they more candidates that just have a pulse?
Well, I think the comments, and we do, for any respondents that are listening, first, I want to say thanks, because you offer an awful lot of comments along with just answering questions, and those are really valuable. To answer this question, I think comments tend to be very um, kind of all over the board, such that I don't think I could answer it directly. What I would say, my gut tells me in terms of labor availability, is that it is probably not because they are expanding or they're loosening their standards. I think that actually happens more when you can't find anybody, when it is extremely difficult. I would say it's probably more that, and we've heard this from other in our surveys of other sectors, that we are just generally hearing that there is more labor availability. Hiring has been a little bit slower, and because of that, people might be working a little bit harder to find a job, whereas before it was quite easy. So I actually think employers are probably not loosening their standards more than they were when things were much tighter.
For sure. And we've had a lot of questions come in about the industrial sector. So can you talk a little bit more about what you think is going on with the slowdown in industrial? Are they more exposed to rate changes?
This is one that I'm going to have to spend more time digging into myself. Um, uh, I would actually say there's probably people on this call that know a little bit more in this area than I do, as someone that is kind of looking at the industry from 30,000 feet. So if anyone has, I would love to get an email from anyone listening that has additional thoughts on this. And so my email's on there, and I'm going to stop sharing now. So you're not continually looking at that, but I'd love any input on that from listeners. Here's my quick take. I think a lot of what was happening um, was that the sector got really busy doing the things that were helping businesses react to the pandemic. So what you saw was a lot of expansion in manufacturing, because we were buying lots of stuff, and then we are expanding a lot in distribution and warehousing. So I think a lot of that, what I'm hearing is that a lot of the warehousing and distribution facilities that were going up everywhere, that pace has slowed. So I think that might be part of it. If others have other ideas about what is going on, I would love to hear more about that.
Sure. And it looks like we're at time today, so that'll be our last question for today. Thank you all so much for joining us, and more information will be in our follow-up email to this event next week.